Hey everyone, today we're going to be talking about part 2 in our Roth Conversion laddering series, and we're going to be talking about a concept that applies more broadly to everyone that is performing a Roth conversion in a given year and will help increase your overall conversion power. Okay. Now, if this is your first time watching one of our videos from the Safeguard Wealth Management YouTube channel and you like our content, don't forget to hit the subscribe button and be notified of all future content that we release. So let's go ahead and get into it, talking about a different variation in Roth conversion laddering. And this will talk about laddering throughout a given year. Okay, so previously in part 1, we talked about an early retirement laddering strategy. I'll link to it up above this video. But essentially how laddering prior to retirement, especially if you're planning on retiring early, can be a powerful strategy. In this part 2 of this Roth Conversion laddering series, we're going to be talking about a slightly different concept, again, that applies more broadly. Okay, so I want to talk at first about a built-in problem of Roth conversions. And it basically comes down to the timing of Roth conversions. Now, think to yourself, when do Roth conversions primarily happen? Okay, well, they generally happen at the end of the year in either late November or December. And the reason for this kind of makes sense. Okay, at the end of the year, we have the best hold, if you will, on your tax situation. So we can be more accurate in making sure we convert the right amount. The last thing you want is to convert the wrong amount, be pushed into higher brackets, potentially be pushed into Medicare premium increases, Social Security tax increases, and various other tax hurdles. So primarily, almost all of us are converting at the end of the year. But if we think about this, this doesn't really make the most sense as far as getting the most out of your Roth conversion. Okay, this would be the equivalent to us saving up each of our 401k contributions till the end of the year and making one large contribution. Okay, we know that it behooves us a lot more to make smaller contributions throughout the year as our paychecks come in. So the question we're going to answer in this video, does it make the same sense on the Roth conversion front? Okay, let's think about the primary reason that we invest is we invest our money because we expect it to grow, right? Okay, well, if the money is available, theoretically, we want to invest that money as soon as possible to start, so it can start earning interest, start growing, if you will. And this is extremely important concept when we talk about converting to avoid a tax problem. Okay, what do I mean? Well, on the screen right now, I have the last 11 years of stock market performance. I'm using the S&P 500 here. Basically, generally, when we're converting from a traditional IRA to a Roth, it's oftentimes to avoid either essentially a future tax problem. Okay, we're trying to avoid RMDs growing out of control. We're trying to avoid when we pull money out in the future being at higher tax rates. Okay, we're trying to avoid certain tax hurdles in the future. Okay, so let's say that we have $1 million traditional IRA or a 401k. Okay, and we want to convert. We want to essentially periodically convert 1/10 of that each year. Okay, so let's just take out growth for a second. That would be $100,000 per year conversion for 10 years. Okay, and so what would happen as we move through time? Let's say we started this in 2010. Okay, well, if we're converting at the end of the year, okay, we have $1 million. Our first conversion, we're planning on it being $100,000. Well, after this first year, okay, 2010 ended up where the stock market was up 15%. Okay, so our $1 million grew to $1,150,000, and now we're converting $100,000. So even after the conversion, we're ending up at the end of the year with more money in our traditional IRA. And we can see this through time in certain given years. Essentially off $1 million, if the market grew by more than 10%, our traditional IRAs are growing despite the Roth conversion. So there's actually only 3 years here where a Roth conversion would have lowered our traditional IRA in this given example, in this simplistic example. And so converting at the end of the year, because again, we expect our investments to grow throughout the year, converting at the end of the year is actually, it appears to not be the most adequate way to convert, okay? And we can see this. Annual conversions, again, looking from 2016 to now, and again, just looking at the broad stock market here, we see that there's quite a bit of just natural timing risk here, if you will. We see that throughout this period, there's 6 conversions. And so some conversions are happening, near the top here of that current market cycle. Some are happening near the bottom here. Notice we're not taking advantage of the COVID crash at all. And basically, it's just very sporadic. Well, what if we applied a different type of strategy? And in the same way that throughout the years we're contributing to 401ks, we're dollar cost averaging in. What if we dollar cost average our conversion? Okay, let's say we did it on a quarterly basis. Well, all of a sudden, we see that we're taking advantage of this market growth throughout the year. Okay, we're seeing that, again, just off happenstance of timing, we're converting at near some market lows. We're also converting obviously near some market highs as well, so those are each offsetting, but nonetheless, we're converting on a more continual basis, essentially dollar cost averaging that conversion. And so is this a way to improve our conversion power? If we rethink the way we convert rather than converting at the end of the year, we essentially dollar cost average that conversion, can it improve our performance? Okay, and there's a lot of different ways that we can convert in a better way than the end of the year. We can obviously convert monthly, we can convert every other month, quarterly, even semi-annually seems to be a better strategy. Now, I will say there are some risks with this dollar cost averaging conversion approach. Okay, something in 2017 was eliminated as part of the Tax Cuts and Jobs Act, something called recharacterization. Basically, prior, you were able to perform a conversion at the beginning of the year. If you ended up converting too much and threw yourself into a tax hurdle or a bad tax situation, you could reverse that conversion, essentially recharacterize that conversion. Well, that is no longer available. So once you make a conversion, you are essentially stuck in that conversion. And so converting throughout the year when you don't have a complete handle on your tax situation does carry some risks. I will say for retirees who generally have a more predictable situation in terms of, let's say they have a pension, Social Security, and are taking $2,000 a month withdrawals from their assets. Okay, well, we should be able to pretty easily estimate their taxable income for that given year, assuming we don't have any other accounts that throw off taxable gains that we weren't expecting. So just beware of the risks. We'll touch on that a little bit later. But applying this strategy will look very different in application based on what kind of essentially strategy you apply. So what do I mean by this? Well, oftentimes we're not converting for the next 30 years. We're not doing, just a general $25,000 conversion for 20 or 30 years. Oftentimes, we're converting around certain tax hurdles. So if you retired at, let's say, age 60, and you're starting Social Security at 70, well, that may mean conversions for 10 years. If you start at 65 to 70, that might mean you're only converting for 5 years. Okay, you might be converting to avoid RMDs. You might not want to do conversions when you're on the Affordable Care Act insurance. So there's all these different hurdles that will essentially hamstring the amount of years that we're converting, if you will. Also, based on what you're invested in before and after you convert, will make a difference as well from this timing standpoint. And also, I'm going to show some examples based on just general timing conversions, meaning that rather than at the end of the year, we're converting each month or we're converting each quarter. But you can convert and ladder these conversions on a different metric as well. Okay, you can essentially try to buy the dip, if you will, and convert, at any point in the year when the market's down 10%. You can convert on a number of other metrics that you find useful. Obviously, that will change these results a little bit as well. But what I want to show here is rolling 20-year performance, and I'm looking primarily at the stock market here, okay? And I'm showing the difference between an end-of-year conversion in red and a blue conversion, and a laddered conversion here in blue. Okay, so we're looking at a rolling 20 years. So as you'll see on this chart, or I guess how you read this chart, is let's say that we're beginning here in 1994. Okay, this result here between the blue and the red line will show 1994 performance through 2014. Okay, so this is starting in January. It'll go from January 1994 to January 2014. The next data point on this chart is February 1994 to February 2014, then March 1994 to March 2014, and so on. So this is a rolling 20-year performance. Essentially, anytime this blue line is higher than this red line, it means this laddering approach beat the just general end-of-the-year approach. And so what we see, let's say we were only converting for the first 5 years, but we wanted to see this 20-year performance. What we'll see, laddering on a monthly basis versus end-of-the-year conversion, we see that on average, the overall improvement is 5.07%. What I show here then, I didn't know the best metric to illustrate the power of laddering, so I showed just the overall performance and then the growth improvement, if you will. So what I'm saying with the growth improvement is we're taking out the Roth conversion contributions, if you will, that we made and are looking at the impact relative to just the pure growth. Okay, so if our Roth IRAs grew to $400,000 and we had made $200,000 in conversions, I'm taking out that $200,000 of contributions, of conversions, if you will, and looking just at the growth. So we'll always see that the growth improvement is higher. And then I'm showing the percentage of the time that this laddering throughout the year approach wins. So in this situation, it's 5% for overall improvement, 7% for the growth improvement, and it wins 85.7% of the time. What if we look at converting for 10 years, but looking at that same rolling 20-year performance, we're looking at an overall performance of 4.16%, growth performance of 6.3%, and we see that laddering wins more times, a higher percentage of times than it did in converting only 5 years. Okay, so there's less timing risk, if you will, from the percent of the time laddering wins. And then if we look at it from a 20-year standpoint, overall performance goes down a little bit, 3.9%, growth performance 7%. Percent of the time that laddering wins is 99% of the time. Okay, so we often see that laddering throughout the year wins a vast majority of the time rather than end of the year conversions. And again, this makes sense. Okay, if we think investments are going to go up over time, we want to apply the same approach that we would for contributions with conversions. We want to dollar cost average those conversions through time. And so on a general basis, just kind of summarizing up these statistics, average improvements based on different time scales, based on monthly, bi-monthly, all the way to semi-annually conversions, the laddering improvements are anywhere from 2 to 10% overall Roth conversion improvements, if you will. Laddering wins 75% of the time. That is a fairly constant metric. Obviously, if you're applying it to different investments, that might change a little bit. But I will note that this analysis only looks at one side of the equation. We're just looking at the raw amount that ends up in the Roth relative to the growth and the amount that you convert. Okay, there's a whole other side of the equation, because typically when we're converting, we're trying to convert from a traditional IRA to lower our tax liability. Okay, as we showed before, if we're converting at the end of the year, oftentimes our traditional IRAs are growing, and it's tough for our conversions to lower that growth, or at least that growth is hampering the power of our conversion. And so over time, converting at the end of the year will keep your traditional IRAs larger, which will likely make the amount that you convert in the future at a higher tax liability. Again, because from RMDs or from whatever, if your traditional IRAs are larger, you're forced to take more money from those traditional IRAs, causing you to owe more taxes over time. And so we're only looking at one side of the equation here. And then maybe the question might arise, is this actually worth it at the end of the day? Okay, if all we're seeing is a 5% improvement, is that worth it? Well, what is the cost of doing this? Sure, there's a little bit of a time cost because you're converting on a more continual basis, but is it worth it will really depend on how much you end up converting overall. So if you're only going to convert $100,000 throughout 10 years, does converting on a more continual basis make as much sense? Probably not on just a pure dollar amount basis. But if you're converting $1 million or $2 million over time, well, 5% of that is $50,000 to $100,000. I would say that's probably worth it. The other thing is, if you're hiring a financial advisor, you're already paying them to provide services. Okay, that it's essentially that financial advisor's job to make sure you get the most out of each of these strategies. So that's something that they can implement that you're already paying them for, or at least they should be implementing if it improves your situation and doesn't take a ton of time. And I will just tell you that doing 12 conversions versus one conversion at the end of the year isn't a huge time difference. Okay, and it's important to make sure that you understand the risks with this strategy. As we mentioned, there's no recharacterization, so you want to make sure you are converting the right amount to avoid whatever tax hurdles you might see in the future. As with any kind of timing, if you will, in certain years, this method will look dumb in hindsight. Okay, for instance, let's say you have a 2008 type year. Let's just say hypothetically, rather than using an exact example, let's say that we have a market crash where at the beginning of the year, the market starts falling, and by the end of the year, it's at its low. Okay, well, in hindsight, converting at the end of the year when the market was at its lowest point would have made the most sense. Laddering that conversion throughout the year, and again, in hindsight, doesn't look like it made as much sense. We're looking at just general statistics and making decisions on the average. Okay, so again, with any timing, in certain situations, it might look dumb. If the laddering approach wins 85% of the time, that means 15% of the time it didn't win. Okay, so notice there is some risk there. But also, as with any Roth conversion tax planning strategy, make sure you have a forward-looking tax plan, okay, going forward into the future. Know what your current tax liability is, know what your future tax liability is. Always remember, you don't need more money, you need a better plan. You need to implement a dollar cost averaging Roth conversion strategy, just rather than just accepting the notion of always converting towards the end of the year. If you like our content, hit the subscribe button. We release content weekly on our Safeguard Wealth Management YouTube channel. Drop us a like if you like this video. Thanks for watching. Feel free to leave any questions or comments that you have in the comments below. Thanks again for watching.